The moment it happened, it felt like just another flash of political theater, another bold warning tossed into the relentless churn of headlines. But within 60 seconds, the consequences rippled through markets, power grids, and the lives of millions. When Donald Trump publicly threatened to impose tariffs on Canadian electricity imports, it wasn't just a jab across the border, it was a spark. And in less than a minute, that spark ignited a surge in wholesale power prices in New York City that left traders scrambling, utilities stunned, and consumers unknowingly standing on the edge of higher bills. To understand why that threat detonated so quickly, you have to understand the delicate web that connects the northeastern United States to its northern neighbor. For decades, power has flowed quietly across the border from Canada into American homes and businesses. It's not a headline-grabbing exchange. It's not a spectacle. It's infrastructure, steady, dependable, invisible, until it isn't. The northeastern grid relies heavily on imports from provinces like Ontario and Quebec, where massive hydroelectric dams generate consistent, relatively low-cost electricity. Companies such as Hydro-Quebec have long supplied power southward, helping stabilize demand during peak seasons. When summer heat pushes air conditioners into overdrive, when winter freezes force heating systems to work overtime, that Canadian electricity doesn't just supplement the grid, it cushions it. So when the former president stepped before cameras and floated the idea of slapping tariffs on imported Canadian electricity, it wasn't an abstract policy debate. It was a direct challenge to a deeply integrated energy relationship. Traders listening in real time didn't hear politics. They heard potential supply disruption. They heard cost volatility. They heard uncertainty, and markets hate uncertainty. Within seconds, energy traders began recalculating risk. If tariffs were imposed, Canadian suppliers might raise prices to offset the added cost. American utilities might pass those increases down the chain. Some suppliers could reduce exports altogether if margins thinned too far. The entire pricing structure for the northeastern power market could shift. In the control rooms of the New York Independent System Operator, analysts monitor flows of electricity minute by minute. They track demand curves, generation levels, cross-border transfers. It's a symphony of data, all calibrated to keep voltage stable and lights on. When political signals threaten to disrupt that balance, even before a policy is enacted, the system reacts. Electricity markets operate on expectations as much as on reality. Futures contracts are bought and sold based on what traders believe will happen. And in that split second after the tariff threat was uttered, expectations shifted dramatically. Wholesale power prices in New York's day-ahead market spiked. Traders anticipating higher import costs bid up prices to hedge against potential shortages. Natural gas plants, which can ramp up production quickly, suddenly looked more competitive, but only at higher operating costs. Renewable sources, already constrained by weather and capacity, couldn't instantly fill the gap, and so the numbers jumped. For everyday New Yorkers, the surge was invisible at first. No lights flickered, no subways halted, the skyline didn't dim. But behind the scenes, the cost of keeping that skyline illuminated had just climbed sharply. Why did a single statement have such force? Because energy is not just another commodity. It's the bloodstream of a modern city. New York consumes vast quantities of electricity every single hour. Skyscrapers, hospitals, financial trading floors, data centers, public transportation, residential neighborhoods stretching across 5 boroughs. The system is built on precision and planning. When uncertainty enters the equation, prices respond instantly, even if actual tariffs never materialize. This wasn't the first time trade rhetoric rattled markets. During previous trade disputes over steel, aluminum, and automobiles, markets reacted swiftly. But electricity carries a unique psychological weight. Unlike manufactured goods, power can't be stockpiled easily at scale. You can't warehouse megawatts for months on end. Supply and demand must be balanced in real time. The northeastern grid's dependence on cross-border flows makes it especially sensitive. Roughly several gigawatts of power can move between Canada and the U.S. at any given moment. Hydroelectric generation in Quebec is prized for its stability and low carbon footprint. Cutting into that flow, even theoretically, forces market participants to consider alternatives. Natural gas prices could rise if more plants are called upon. Carbon emissions could increase if cleaner imports are replaced with fossil fuels. Infrastructure bottlenecks could strain transmission lines already operating near capacity. Within minutes of the announcement, analysts on Wall Street began publishing alerts. Energy markets volatile following tariff comments. Cross-border electricity trade at risk. Potential cost impact to northeastern utilities. Investors holding shares in utility companies saw stock prices fluctuate. Power producers evaluated whether to lock in higher forward prices. Hedge funds smelled opportunity and volatility. The White House, now occupied by a different administration, quickly moved to temper fears, signaling that no immediate policy change was underway. But in energy markets, damage from uncertainty often precedes clarification. The political calculus behind the tariff threat was complex. Trade tensions with Canada had flared periodically over dairy, lumber, and manufacturing subsidies. Electricity became the latest symbolic battleground. But unlike lumber shipments or agricultural quotas, power flows are deeply entwined with grid reliability. Some political supporters applauded the hardline stance, arguing that the U.S. should prioritize domestic generation and reduce reliance on foreign imports. Others warned that tariffs would act as a tax on American consumers, raising utility bills in cities already grappling with high living costs. Energy economists pointed out that tariffs on electricity differ from tariffs on physical goods. Power markets clear at marginal prices determined by supply and demand curves. Injecting tariffs into that equation distorts bidding behavior. Generators anticipating higher import costs adjust their offers upward. Utilities hedge more aggressively. Consumers ultimately absorb the increase. In New York City, where millions live paycheck to paycheck, even small increases in electricity rates can ripple outward. Restaurants operating on thin margins, small retailers managing rent and payroll, families balancing heating costs in winter. Behind the dramatic headline, NYC's power prices exploded, lies a chain reaction rooted in market psychology and infrastructure physics. Consider how tightly synchronized the grid must be. Electricity flows at nearly the speed of light. Frequency must remain precisely at 60 hertz. Too much demand and frequency drops, too much supply and it rises. Grid operators maintain balance by dispatching generators and managing imports in real time. If tariffs made Canadian imports more expensive, some U.S. utilities might reduce purchase volumes. That reduction would need immediate replacement. Gas-fired plants could step in, but fuel procurement and ramp-up rates matter. Transmission congestion could limit how much additional domestic power reaches dense urban centers. So even the mere suggestion of tariffs introduces perceived fragility. Markets price in worst-case scenarios. Within an hour of the remarks, analysts began estimating potential impacts. If tariffs added, say, 10% to imported electricity costs, wholesale prices in peak demand periods could rise by several dollars per megawatt hour. Multiply that across millions of megawatt hours annually, and you're looking at tens or even hundreds of millions in additional system costs. Critics argued that the move contradicted broader goals of grid decarbonization. Canadian hydroelectricity is among the cleanest large-scale energy sources available to the northeastern U.S. Reducing its competitiveness could slow progress toward emissions targets. Environmental groups issued statements warning that replacing hydro imports with fossil fuel generation would increase greenhouse gas emissions. Business groups cautioned that unpredictable trade policy undermines investor confidence in long-term energy infrastructure projects. Meanwhile, Canadian officials responded with measured firmness. They emphasized the mutual benefits of cross-border electricity trade and signaled readiness to defend their energy sector if necessary. Diplomats quietly opened back-channel discussions to prevent escalation. But the markets had already spoken. In trading floors lit by rows of monitors, algorithms reacted faster than humans could. Automated systems parsed the speech transcript, flagged keywords like tariff and Canadian electricity, and triggered pre-programmed trading strategies, buy orders, sell orders, hedging positions. The velocity of modern markets transforms rhetoric into dollars within milliseconds. For ordinary New Yorkers, the story unfolded later in news alerts and evening broadcasts. Power prices spike after tariff threat. For many, it sounded distant, another political skirmish. Yet the cumulative effect of such volatility can shape long-term rate structures. Utility companies often purchase electricity in forward markets to lock in prices. If volatility persists, those contracts become more expensive. Regulators then face pressure to approve rate adjustments to ensure grid reliability and financial stability. And there's another layer: investor perception of political risk. Infrastructure investment thrives on predictability. Power plants, transmission lines, renewable projects, these require billions in capital and decades-long planning horizons. When political leaders signal abrupt trade shifts, investors demand higher returns to compensate for uncertainty. Higher required returns translate into higher costs for consumers. The episode also underscored how interconnected North America's energy systems have become. The border between the U.S. and Canada is long, but in energy terms, it is porous. High-voltage transmission lines cross forests and rivers, linking provinces and states into a shared electrical ecosystem. For decades, policymakers encouraged this integration, seeing it as a path to reliability and economic efficiency. When drought reduced hydro output in one region, imports could compensate. When heat waves spiked demand in another, cross-border flows smoothed the curve. Tariffs threatened to fracture that ecosystem. Supporters of the tough trade stance argued that short-term pain could incentivize domestic investment in generation capacity. Build more power plants at home, they said. Strengthen energy independence. Yet critics countered that such shifts take years, not minutes. In the interim, consumers bear the brunt. By the end of the trading day, wholesale electricity prices had partially stabilized, but remained elevated. The spike served as a warning shot, a demonstration of how quickly markets react to geopolitical signals. Political leaders often measure impact in polls and headlines. Energy markets measure it in megawatts and dollars. The broader lesson from that 60-second explosion in prices is not just about tariffs. It's about the fragility of systems we rarely think about. The light switch on the wall, the hum of refrigeration, the glow of office towers at night. Behind each of these conveniences lies a complex choreography of generation, transmission, regulation, and trade. Disrupt that choreography, even rhetorically, and the consequences are immediate. As night fell over New York City, the skyline shimmered as always. Times Square blazed, bridges glowed, apartments flickered with life. Most residents never knew that hours earlier, a political statement had sent shockwaves through the market that powers their lives. But in boardrooms, trading desks, and government offices, the message was clear. In an interconnected energy economy, words carry wattage. The next morning, commentators debated whether the tariff threat was strategic leverage or economic brinkmanship. Analysts parsed every follow-up statement from officials. Would formal proposals follow? Would negotiations diffuse tensions? Would markets calm? For now, the incident stands as a vivid case study, a reminder that energy security is inseparable from trade policy, that markets respond not just to laws enacted, but to possibilities imagined. That 60 seconds can be enough to jolt a city's power prices and reveal the invisible threads tying nations together. In the end, perhaps the most striking element was not the spike itself, but its speed. The modern energy economy operates on razor-thin margins and real-time information. Political leaders speak, algorithms listen, markets move. And millions of people flipping on lights in kitchens and offices remain blissfully unaware that somewhere in less than a minute, the cost of that light briefly soared. Proof that in today's world, even a threat can carry electric consequences.